A 2020 Australian house price crash. Let's have a look. Hello everyone, Florian Heise here, and welcome to another episode of Heise Says. I've got my plastic cup of ice cold water today because it's 35 degrees outside right now. And you might hear the kids screaming and playing in the background because last I heard it was hoses versus mud as the game they're playing. But, you know, that's good old Australian growing up. I remember playing in the hose on these hot days. So, let's have a look at this article. This was one shared to me by a viewer from Yahoo Finance Australia. And a house price crash in Australia named a potential risk, global risk, for 2020. And what issues that could have for the rest of the global economy. So, let's have a look through this. So, Deutsche Bank has warned a potential house price crash in Australia is one of the top 20 risks to the global financial markets in 2020. What, is number one going to be Deutsche Bank? I mean, there you go. Everyone saw the little Reddit thing that was going around. Deutsche Bank's going to go bankrupt, you know, and people were spreading it after the date it was meant to go under had passed. So, in a note sent to clients obtained by CNBC, Deutsche Bank said Brexit uncertainty, trade war concerns, and an increase in wealth inequality and income inequality were also major concerns. Well, yes, I mean, Brexit uncertainty. Will Brexit actually happen in the UK? That's going to be interesting. The election results are going to be fascinating to see there. I mean, trade war concerns. We might be getting the phase one trade deal, although I wasn't aware that it was a multi-phase trade negotiation, and then it'll be all phase two. Wealth inequality. Well, yeah, that is just growing. That is really growing here in Australia. And the biggest concern is that a lot of Australia's wealth is in housing. 57% of it in our housing stock. So how much of that is actually wealth in productive assets? And if we get a huge crash in 2020, what do you think that will do to the wealth of the nation? So this is the complete list, and let's go through each of the items they have identified. So continued increase in wealth inequality, income inequality, and healthcare inequality. Now, this is wealth inequality and income inequality. Well, wage growth has completely stagnated. We've only seen differences in wage growth with the private and public sector. There's a huge difference there. But another thing we need to consider is wealth inequality. Now, if these countries, more and more reserve banks, start implementing quantitative easing, what do you think that's going to do? That will mainly drive up the value of assets and already the asset holders and cause more wealth inequality. So it's just going to be a perpetual loop. And that's not even considering the direct purchasing the reserve banks will have to do. So phase one trade deal remains unsigned. Continued uncertainty about what comes after phase one. Yeah, that's it. Is phase one just going to be a return to the status quo, as Peter Schiff is alluding to? Or is it going to be something of actual merit? What implications will that have on the Australian economy, guys? So trade war uncertainty continued to weigh on corporate capex decisions. So this is essentially, you know, capital expenditure, cap investment that businesses are doing. You'll find often when there is an election, a lot of businesses will hold off on investment or large purchases which they can avoid, which they can delay, because there is an unknown of what's going to happen. I saw it all the time here in the construction industry. Whenever there was an election, a state election or a federal election, generally slow down a bit. You'd hold off until to see what was happening, particularly if government decisions would have an impact. So ongoing slow growth in China, Europe, and Japan, triggering significant US dollar appreciation. Has Japan ever had fast growth in living memory? Impeachment uncertainty and possible government shutdown. Oh, will the impeachment ever is it even possible? I don't think it is. I think it's just another bunch of noise forcing all the Democrats in the US to discuss Trump. So, yeah, we'll see. Government shutdown, that's an American issue. Will that have implications here in Australia? Perhaps, not as much as people realize. So US election uncertainty, yep. Implication for taxes, regulation and capex spending. Well, yes, yeah. I mean, some of the things that the Democrats are talking about is just very interventional, shall we say, in the economy. Antitrust, privacy and tech regulation. Foreigners lose appetite for US credit and US treasuries following presidential election. Oh, yes. So MMT style fiscal expansion boosts growth significantly in the US and or Europe. Can it in Europe? Aren't they? They're already going nuts with their money printing and QE. It's to infinity. We've got not QE in the US with the repo issue that's just going on. So, yeah, well, US government debt levels begin to matter for long rates. Mismatch between demand and supply in T-bills, another repo rate spike. The Fed reluctant to cut rates in an election year. Oh yeah, that's another consideration over in America. They've still got a bit of room to move, not like Australia and other countries, or countries that are even in negative. So credit conditions tighten with more differentiation between CCC and BBB corporate credit. Credit conditions tighten with more differential. Okay, they've said that twice. Oh, sorry, CCC and BBB consumer credit. Fallen angels, more companies falling into BBB and or out of BBB into HY. This is to do with the ratings agencies. So the worse your rating agency, the worse your ability to access funds. More negative yielding debts sends global investors on renewed hunt for yield in US credit. Declining corporate profits mean fewer dollars available for buybacks. Well, I mean, this is the thing. Okay, this is the thing. Buybacks, share buybacks, are they necessarily a good thing? So, I mean, look at Apple, that you buy shares, then the company goes, buys the shares, destroys the shares. Their earnings remain the same, but their earnings per share increase. So the company looks like they're performing better. They're doing better because they're buying back the shares. And it's, smoke and mirrors, really, how much of that has been going on in the US. And think about it, that's not a real investment in the economy, as in it's not going into productive things. Sure, it's going back into the hands of the shareholders. What are the shareholders going to spend it on? Probably more stock. So let me know what you think about buybacks, guys. The shrinking global auto industry, a risk for global markets and economy. Now, I've been following a few YouTubers that are discussing this industry in the United States and some of the issues that are going on over there, and it is flowing through here. More and more people are telling me to look at auto loans, and I will have to look into that, what's happening here in Australia. And then next we have house price crash in Australia, Canada, and Sweden. So let's have a look. We'll jump over to one of my favorite websites, and we'll just look at one bit of data that I think is interesting. And this is the household debt to GDP, and household debt that combines all of the debt in the household, the consumer debt from all the people, and the mortgage, those type of things. And then when you look at it, if from total to GDP, you can see Sweden, they're at 88.4%. 88.4%. Let's have a look at Canada. They're at 101.3% of GDP. So 101.3. So they've shot up since the last measure. And then let's look at good old Australia. Come on, Aussies, how are we going? And look at that, we're at 119.4. We've actually gone down. Household debt in Australia decreased to 119.4% of GDP in the first quarter of 2019 from 120.1% of GDP in the fourth quarter of 2018. Household debt to GDP in Australia averaged 71.9% of GDP from 77 until 2019, reaching an all-time high of 122% of GDP in the third quarter of 2016 and a record low of 34.2% of GDP in the fourth quarter of 1977. So, I mean, this can show you just the level of stress that this is going to pose to people. Now, earlier today, we looked at mortgage arrears and how they are going higher and higher. And let's just have a look at that data. You can see here just the delta change from, 2016 to now. Look at WA and NT, guys. Look how much higher that is. Red are people who are 150 days past due. Okay? So, they may say it's historically low, or they're comparing it to the American GFC. At least that's what one of the governors did at our Reserve Bank. But you have to understand some of the fundamental differences, where in America people can just walk away and the debt stays with the house. Here in Australia, you are literally, it's like in some ways we're playing Outer Worlds. We're signing an indenture contract to the bank, and we're indebted to them for the house that we have. So you've got to work hard to pay it off. And then finally, it's Brexit uncertainty persists. So these are the 20 issues that they have raised. So according to IBIS World, continued interest rate cuts from the Reserve Bank of Australia present risk, especially if cuts continue into negative figures. The RBA has stated that it would consider using a quantitative easing style program to inject more money into the economy. Ideally, the recipients of these funds would use them to make greater investments and generate economic activity. Okay guys, this is the issue. Where has all our investment gone? It's gone in housing. Australia is a housing nation. I'll bring up a quote from Matt Berry just to drive this home, everyone. In 2016, 67% of Australia's GDP growth came from the cities of Sydney and Melbourne, where both state and federal governments have done everything possible they can to create and fuel a runaway housing market. The small area from the Sydney CBD to Macquarie Park is in the middle of an apartment building frenzy, alone contributing 24% to the country's entire GDP growth for 2016, according to SGS Economics and Planning. This is from his Medium and LinkedIn super post he did, where Australia is built on a house of cards. And we're looking at recently just wage growth, housing affordability, and some of the issues with regards to how much of our wealth is in housing. So if there's more money and increased quantitative easing, how do they do it? They'll buy bonds and purchase these things off the market. That'll increase the value of that. And the theory is that it will flow through everywhere else. Now the problem is, what are they going to invest it in? Either more securities, more equities, more housing. Come on guys, why wouldn't they? Housing never goes down, remember? So however, the effectiveness of this policy in Australia is likely to be limited given the existing abundance of money supply, said senior analyst Jason Aravanis, said in a note. It is also possible that these funds will flow into the property market instead. Consequently, this measure risks only further inflating housing prices rather than stimulating the economy. I would bet a carton that that's all that will happen. We're going to lose value, money will lose purchasing power, and it'll create another housing bubble. What do you think, guys? Let me know what you think. RBA Governor Philip Lowe also warned in September that progressive rate cuts run the risk of just pushing up asset prices. Lowe has consistently pushed for the government to explore other measures of boosting Australia's flagging economy, and other economists have echoed his calls. Given Australian households carry an egregious amount of household debt, already policymakers need to find ways to generate growth that doesn't rely on credit, IFM economist Alex Joyner said on Thursday. He was responding to former Federal Treasurer Peter Costello's comments that Australia's monetary policy plans are running out of gas. Well, yes, they certainly are. They certainly are. Aggressive monetary policy easing by central banks has created a situation in which accommodation is now more difficult to remove, Joyner added in a note. Given the high level of private debt across the developed world, rising interest rates are much more powerful than in the past. Monetary policy has become a very asymmetric tool. Further policy easing will likely have limited impact on corporate and household behaviour, but raising rates will likely have a material impact on the heavily indebted households, particularly newer borrowers. Well, controversial real estate pundit Harry Dent has also said Australian house prices are 40% overvalued, with a crash still on its way. But the head of SQM Research, Louise Christopher, told News Corp's dense words should be taken with a fair grain of salt. I'm concerned for people who get hoodwinked into his seminars. Well, what do you think, guys? Do you think houses aren't 40% overvalued? One argument I would put to you, and we'll bring this chart up, this is showing you the amount of foreign investment into our housing. The black line, that line shows you the percentage of, FIRB, Foreign Investment Review Board, approved investment in new housing as a share of ABS residential bulk approvals. Building approvals. So when you need to have building approvals for houses. So look at that. FIRB approved investment in new housing. That was over 90%. Do you think that would heat up our market artificially? Do you think people investing in our housing from overseas that are not living here? Yeah. No. I'm sure it's all fine. Definitely worth that much. So, the Sydney and Melbourne housing markets have recorded a sharp turnaround in the second half of 2019, following on from the surprise results of the federal election, interest rate cuts, the loosening of credit restrictions, and ongoing strong population growth rates. These factors are expected to drive the national housing market into 2020. In a close call, APRA is expected to not immediately intervene despite strong price rises, Christopher said. However, we have some misgivings on the sustainability of this new recovery. Sydney and Melbourne are rising from an overvalued point. Long term, our two largest housing markets look vulnerable and forever reliant on cheap credit. Housing debt, while falling compared to GDP over 2019, is still very high. Better value can definitely be found elsewhere, such as Perth and Brisbane. So, what do you think, guys? What do you think? It's interesting to see all of the other concerns that they have raised. I mean, it just shows you. It shows you. This is why I was talking to a friend this morning. This is why there's a lot of FOMO out there. The market is just frantically responding to even the slightest tweet or the slightest potential of good news. I think a lot of people are worried. I think, the record of the Reserve Bank, to make predictions. Well, I'm not confident in that, and I really am concerned. I'm concerned with the extent and the increase of housing loan arrears, and I will link to that video above that I did earlier today. But let me know what you think in the comments, guys. Are you concerned? Do you think it's all going to be peaches? Do you think Australia could be the domino that starts tipping everything over? Anyway, guys, thank you for watching. Like, share, and subscribe. If you're a fan of the channel and want to help me produce more content, I have a Patreon and a Subscribe Star where you can make a small monthly donation. I also have Amazon and eBay affiliate links, where if you make a purchase, I receive a small kickback at no cost to you. And finally, I have PayPal and Ethereum if you want to make a donation using those means. Take care, guys. Have a great weekend, and stay out of the sun. Bye for now.